I think you sit tight. The fact is that, we do have higher rates ahead of us. It is going to be a headwind for the next 18 months, 12 to 18 months or so. But I'm not so sure if you've got huge embedded gains that you want to take those gains and try to sit it out and get back in. Understanding that equity investing is somewhat of a longer-term game. I wouldn't invest in equities unless you had a 7-year horizon or more. So in that context, I'd say stay with it. If you've got cash, that's a different matter. I think cheaper prices, cheaper entry points are ahead.
Michael, same question to you.
I think we're going through a bit of a storm here as investors. And it's a storm of revaluation. We've seen for the past couple of weeks markets really get rocked. I talked with Kenny Polcari earlier. We've broken another 200-day moving average today. This market is finding a new level. And you really don't want to try and throw yourself out on the deck when the ship is rolling and pitching. So this is when a long-term investor with a long-term strategy, I think, does what Jack was just saying. You stay the course, you keep your powder dry, and with any luck, you know as a long-term investor you're going to hit the rough spots. We're not sure how this one's going to play out yet. Could this be the beginning of a significant pullback? Sure, it could. It doesn't really feel that way.
Why not? Why doesn't it feel that way this time?
The economic data are too strong underneath. I mean, we don't have the banking crisis. We don't have that. So we've got ridiculously low unemployment. We've got low interest rates relatively. We've got a lot of good stuff going on economically.
Agreed completely. But Jack, perhaps, when the markets were 5.5% higher from where they are right now at record highs, was that pricing in what we have in the economy right now?
It's hard to know if it's priced in. I mean, things get a little, get overdone one way or another. But I will say, I agree with Michael. I think that if you strip away, forget this downdraft for a minute and look at just credit conditions, okay? Normally, I would, if I started to see lenders started to maybe close their pocketbooks, maybe start to require a higher premium to extend credit to lower quality borrowers, I'd say, hey, that's a liquidity crisis or a liquidity problem that's cause for concern. We haven't seen any of that right now. This, to me, sounds like just a simple correction. The fact is that interest rates are too low. I don't believe the Fed is loco. I still believe that overnight rates are below where they should be, and I believe the 10-year Treasury should be 4.5%. So we have to get there. It's going to take about 18 months or 12 to 18 months, and I think those are the headwinds.
Okay, so Michael, which particular rough spots are you paying attention to?
Well, Melissa, I think one of the things they say is that the market in the short term is a pricing mechanism. I think Buffett says this. In the long term, it's a weighing mechanism. So one of the things I think that you've got to pay attention to are the short-term rates. You have to pay attention to what the banks are doing. You have to take a look at credit quality, too. And in bank earnings, we still see pretty pristine credit quality. We're not seeing bad signs, but we are seeing a market that suddenly seems to have...
As fewer people apply for mortgages, are you going to start to see that change?
Yes. I mean, you're going to see, so those rates are going up, and we've got real headwinds to the real estate market. These rising rates are headwinds, and I think the market's recognizing that now. Are those headwinds sufficient to actually shove us back into recession? My answer right now is no. Economic strength and momentum is sufficient to endure these headwinds. We're going to see. That's one of the things the president's been saying. The president's been saying we can afford to do tariffs now and have these conversations now because our economy is so strong. The whole key here, as I said on January 3rd when I was with you all this year, the whole key and focus of 2018 is going to be on interest rates, and Jay Powell has the toughest job in the world.